Yo, what is up guys, Ryan C here, and I've spent the last decade of my life inside different financial institutions and hedge fund environments, and today we're going to break down one of the most misunderstood but most important concepts in trading: market structure. If you guys don't understand market structure, everything else you learn in trading is going to feel very random. Entries won't make sense, stops are going to feel unlucky, and wins are going to feel very accidental. So hopefully by the end of this video, you'll understand how price actually moves, how professionals read it, and how you can stop trading blindly. So let's dive right in. What market structure really is. Market structure is the blueprint of price behavior. It is how price organizes itself over time and how the market communicates its intent. You see, every candle, every swing high, every swing low is part of a larger narrative, right? Market structure is how we read that narrative logically instead of using our emotions. At its core, market structure answers one very critical question, I'd say. Who is in control right now? If the price is making higher highs and higher lows, as you guys can see here in my chart, then obviously buyers are in control. But if it's making lower highs, lower lows, obviously sellers are in control. If price is moving sideways, as you guys can see right here, then control is being negotiated between the buyers and the sellers. And this is why market structure always comes before you even think about your entries. Before you think about buying or selling, you have to understand where price sits in its overall cycle. See, structure gives you context. And without context, every single trade you take is going to be a gamble. Professional traders like myself, we do not predict. We react to structure, and we allow price to show its hand first of all, and then we align with it, you see? So let's go into consolidation and ranging, because these are often misunderstood a lot. See, consolidation, otherwise known as ranging, is when price moves sideways between a defined high and low without committing to a single direction. As you guys can see here, just breaking up, breaking down, very called choppy price action. During consolidation, the market is absorbing orders. Large participants are either accumulating positions or distributing them. And this phase is where most retail traders lose money because nothing looks clear here. And, you know, as traders, as retail traders usually do, impatience takes over. You see, price may break above the range, as you guys can see here, and then snap down right back inside. It may even break below the range, as you guys can see here, and then again, reverse. This is not manipulation. This is liquidity being collected. Huge misunderstanding there. You see, ranges exist to test market discipline, to test traders' discipline. You see, most traders try to force trades inside consolidation ranges, while professionals, we wait for this consolidation, this choppy action to resolve itself. The goal is obviously not to trade more. The goal is to trade when probability to win increases. You see, a clean range gives you clear boundaries. The highs act as resistance, as we see over here, where my cursor is, and the lows, as you guys can see where my cursor is right now, they act as support. Everything inside this, everything between that resistance and that support is just noise until further notice. All right, let's go into expansion. Expansions typically happen after consolidations, and expansion is the moment that the market starts to commit to one direction. As you guys can see from what I'm showing you, in this correction, the expansion committed upwards. It is the strong, impulsive move away from consolidation or whatever previous structure there was. Expansion shows intention. It is where real imbalance begins to enter the market. This is where many traders start to chase price and enter late, but expansion is not for entries. Expansion is for direction. After expansion, the market needs to retrace. Keep that in mind. Retracement is not a weakness. Let me show you guys a retracement on my chart right here. So consolidation, expansion, and retracement. See, retracement is not weakness. It's necessary for any healthy market condition. See, price pulls back to rebalance, mitigate risk, and allow new participants to enter at better prices. You see, a healthy trend expands, then retraces, then expands again. And guys, expansion doesn't have to happen necessarily only upwards. Expansion can be expansion downwards, as you guys can see over here on my chart. You see consolidation, expansion downwards, retracement, expansion downwards, retracement, expansion downwards. Expansion doesn't have to be in a certain direction. It doesn't have to be up. It doesn't have to be down. Expansion is just that aggressive move that happens. And retracements are, I'm showing you with my cursor right now, these small miniature retracements in the market before another leg down or another leg up, depending on where expansion is headed. You see, if price never retraces, it becomes unstable. And if retracement breaks structure, then that is information. It tells you that the trend may be weakening or shifting. Understanding the relationship between expansion and retracements, that prevents emotional decisions in the market. And your job as a trader is to totally negate emotions the second you jump into the markets. You have to stop chasing moves and start waiting for proper logic. Now, let's dive right into market accumulation and market distribution. You see, accumulation is the phase, as you guys can see over here, is the phase where smart money builds positions quietly. It often occurs after a prolonged downtrend or during long periods of consolidation. If you guys have a look at the chart right here, I was just telling you guys how in a market accumulation phase, it happens when price is moving slowly, volatility is low, volatility is not spiking. And as you guys can see from the chart I'm showing you guys over here, nothing much is happening in the accumulation phase. There's nothing really breaking out clearly. There's no obvious trend going on, right? That's called accumulation. Think of it like this. When accumulation is going on, the biggest banks, JP Morgan, Goldman Sachs, these guys fill up their orders, put money in the market, get their proper entries. That's usually what happens during market accumulation. So yeah, as mentioned, volatility is low, and retail traders like yourself, they tend to lose interest in phases of market accumulation. And that's very important. The retail traders losing interest is a super important point, and it's super intentional because large institutions, they cannot enter all at once. They need time, they need liquidity, and accumulation provides both time and liquidity to these massive conglomerates. See, distribution, as you guys can see here, is the complete opposite. It occurs after an uptrend when smart money begins to exit their positions. Before the massive leg down, nothing is clearly going on. Let me just break this down super simply for you guys. Accumulation, where smart money is entering, and then the big moves upwards start coming, and then institutions begin to slowly selling off their positions. And then over here at this point, before the massive leg down, just think where you cannot see this massive leg down right now. Retail traders are still a little bit optimistic. They still have hope that, okay, the market is gonna somehow flip back bullish. And so over here, when the public is still optimistic, distribution comes along and demolishes everyone. Because before this massive leg down happens, headlines are still positive, and that optimism, that's liquidity. See, distribution transfers risk from professionals to retail traders. The market does not crash immediately. It creates false confidence first. See, and understanding accumulation and distribution allows you to stop buying tops and selling bottoms. You begin to see when moves are being built versus when they're being sold into. Over here, they're being sold into, right? So guys, all in all, this lesson about market structure was not a strategy, okay? This is a foundation. We're telling you guys the higher highs, the higher lows, the consolidation, the ranges, the expansions, the absolute basics of the market, the phases of the market that you need to understand so you can really at least have a solid base once you start diving into the financial markets. Just to recap everything to you guys, consolidation shows preparation. Expansion, it shows intent. Retracements in the market, they show opportunities. And accumulation and distribution, they show institutional positioning. Once you understand this cycle, the market becomes calmer, trades make more sense, your risk can become more controlled, and this is how professionals read price action. Like I always tell you guys, think less, trade better. See you in the next YouTube video.